It's my pleasure to welcome you to this special session at the Center for Global Development, where today we have the pleasure and privilege of welcoming back Kristalina Georgieva, the Managing Director of the IMF. Kristalina, welcome. We're very happy to have you here. Uh, 1 year into the job, a year like no other that anyone could have anticipated. You just come out of the annual meetings of the IMF and the World Bank as well. I want to sort of start off really by asking for your take on where we now stand. How did the annual meetings advance the agenda? And then there are so many other things that I'm sure we'll want to talk about. I also want to remind our viewers that they can send questions, and we will try to take those as well.
Uh, Thank you very much for the invitation to come back, Masood. Let me express my huge respect for the work of the Center for Global Development. You have been one that always keeps the bar high for everybody that is engaged in these topics. And I hope that you will continue to do so, and especially to stand up for those that are at highest disadvantage in this very dramatic time we live in. We have experienced a tremendous shock that led to the worst recession since the Great Depression. And our annual meetings, virtual for a first time in our history, demonstrably brought the world together. We have had record high number of participants, very engaged discussions, all a reflection of the seriousness of the situation we find ourselves in. My main takeaways from the annual meeting. One, very strong alignment of the membership on understanding that this is a crisis like no other, and therefore the response has to be like no other. That translates into uniform acceptance that this is going to be a long ascent, uncertain, uneven, prone to setbacks. In other words, the recovery is not going to be across the world as rapid as the drop of output has been. Secondly, practically uniform alignment of the membership on the need to sustain support for businesses and for households until we have a durable exit from the health crisis and private sector picks up steam. That keep the support for as long as it takes is not the usual message that comes from the fund. This a slogan we crafted, spend as much as you can, but keep the receipts, has been adopted by the membership. Three, a sober recognition that spend as much as you can is a very different entity in advanced economies, in emerging markets, in low-income countries. In advanced economies, whatever it takes. They have deployed an incredibly high amount, 20% of GDP in fiscal and monetary accommodation measures. In emerging markets, it is 6 to 7%, many times less. In poor countries, 2%. In other words, whatever it takes, as much as you can possibly do, and it is not a lot. And that defines the role of the fund to help these countries deal with this dramatic crisis. Three, the recovery is once in a lifetime opportunity as we deploy massive stimulus to support a transformation in the economy. In other words, don't recover what we had before this crisis, do better. Greener economy, one that is digitally enabled everywhere, and a fairer economy. And as you do that, recognize that for some countries, debt vulnerabilities are already very high. Sorting out debt to allow for that transformation, for recovery in these countries is paramount. And finally, one very uh, touching bright spot of the meetings. We embraced our newest member. The IMF is now 190, with Andorra being the latest to join. And symbolically, I thought that was quite significant for us, a recognition we are in this together. We can only get out of it together.
So that gives us a very nice kind of overall picture of where things stand. Um, I want to drill down a little bit and get your sense, if I may, of what this recovery process is going to look like for the poorest countries. Because if you take Africa, for example, um,
Mm,
the direct health impact of the pandemic wasn't as bad as we had feared a year ago, but the economic impact is already bad, and you can
mm,
see that it's going to stay bad. I think there's a new blog out from the fund today that pointed out, or a podcast pointing out, that per capita incomes in Africa are where they used to be in 2013. So there's
mm,
clearly been a drop. And as you said, in terms of their ability to compensate, it's a tenth as a share of GDP of what the rich countries have been doing,
yeah,
20% and 2%.
yeah.
And of course, the 2% is of a much smaller base. They're already
Yes.
poor. They don't have much of a cushion to start with. So the pandemic, the health crisis will take probably, we have some colleagues in CGD do a report recently. And, by the time the world is sort of vaccinated and out of it,
Mm,
realistically, we're talking
mm,
2.5 more years. So this is still a continuing thing for many countries,
mm.
and dealing with it. So how do you see that long uneven ascent that you're talking about for them, and are they ever going to get back? I mean, at what pace do they get back to where they've fallen off
Yeah,
from, let alone go
yeah.
beyond towards SDGs?
You are very right to zero on the countries that find themselves in gravest difficulty in this crisis. If you look at the first months after the pandemic hit, what you see is shock everywhere, advanced economies in a synchronized manner stepping up, and I want to say bravo to ministers of finance and central bank governors for what they have done to put a floor under the world economy. Emerging markets with good fundamentals very quickly taking advantage of this massive injection of liquidity, borrowing at very low cost and injecting this liquidity domestically to accelerate a recovery. Not a single sub-Saharan African country has issued debt since the beginning of the crisis. So we have a number of countries that find themselves very in a very restricted space, domestically limited resources, externally limited access. That defined our first responder action. In these months of the initial response to the crisis, the IMF has provided financial lifelines to 81 countries. Small number of those countries are strong fundamentals where we just increase their buffers. Majority are countries that are faced with difficulties. 48 of these countries are low-income countries. I can genuinely say, you know it, you know us very well, never in the history of the fund we have done so much so quickly for low-income countries. On average, 10 times more than we would lend in a year. Now, that was and remains critically important to stabilize countries against this shock. And then the question is, what next? We are already working in the fund and of course working with our colleagues at the World Bank and other institutions on the next generation of support. We are increasing our concessional lending capacity because it is very clear these countries need help. They need financial buffer. They also need very serious engagement on debt. So let me separate these two topics. And I will actually start from debt because dealing with debt opens up space, fiscal space, policy space for action. On debt, it was remarkable that in virtually weeks, the G20 came up in April with the debt service suspension initiative. David Malpass and myself called for it. And multilateral processes, getting action so speedily is a reflection of the seriousness of the moment. This debt service suspension initiative is now extended for another 6 months. I'll tell you, I thought it should be extended for a whole year. The compromise is in 6 months, if needed, it will be extended further. But it is not enough. What it does, it provides some breathing space, very appreciated, but limited. We got in the first 6 months, we got 5 billion delayed payments. Well, 5 billion is not nothing, but you compare it to 12 trillion of fiscal stimulus in G20 countries, it's not that much. We actually funded much more with the emergency financing from the fund. We have provided on our own 500 million of debt relief to 29 countries, so they don't have to pay us while they're struggling. One big achievement is the common framework for official creditors and also the call to private sector to step in. I welcome those, and we need to make sure they deliver tangible benefits. But even with that, we're going to have a small number of countries where it is not anymore viable to just kick the can down the road. These countries would need debt restructuring. We saw two examples, Ecuador and Argentina, not low-income countries, middle-income countries. We now have the very pressing case of Zambia, a low-income country in debt distress. Our message to countries is let's work constructively, and when debt needs to be restructured, possibly to shrink the mountain on your shoulders, let's act early and act decisively. And for this reason, as I'm sure you have noticed, around these meetings, the fund came up with two propositions. One is on international architecture for private sector participation in debt restructuring, how to improve this. And the second one is to make that call for the a common framework to demonstrably improve debt restructuring when it is necessary, and we would do our best. So this is the issue of debt. We have to be seriously engaged on it. And then comes the issue of deploying limited fiscal space.
So could we maybe do debt since you talked about debt?
Yep, sure.
I thought we might just take a couple of minutes on debt
Of
before we
course,
go to
of
fiscal.
course.
So a lot of people have been writing about the DSSI.
Mm-hmm.
I think everybody agrees it was a very useful, timely. $5 billion is $5 billion.
Mm-hmm.
It's half of what was anticipated at the time, but private sector at the end of the day didn't do anything. I mean, they weren't really very. So we had a few calls to the private sector, exhortations, but nothing came of it. And now we've extended it for 6 more months. So that's actually another 6 months of relief. Not obvious why the private sector will be any more forthcoming in the next 6 months than it has been in the last 9 months, but let's hope. And as you say, in a way now at these meetings, people begin to recognize that for a set of countries, liquidity relief through postponing repayments is all you need. But there will be a set of countries, and we don't really know the number, and maybe the fund and the World Bank are the institutions that will provide the framework for thinking about it. But there's probably some number that is large single digits, low double digits, who knows, of countries, low-income countries that will need to go beyond liquidity relief into dealing with that restructuring and debt reduction. So at the end of the day, David Malpass has been very forthcoming in sort of saying this is needed. You've said it, so I think this is out there. I guess my question now would be, how do we go from here, where people are sort of broadly recognizing that this will need to be done? I think you've just said, which is exactly the right thing, which is that the history of debt reduction initiatives is that there are many examples when it happened too late with high cost. There's no historical example when it happened too early. When we look back and say, gee, we should have done it later, most people think we're on track to repeat history, because we will actually end up doing this too late. So a lot of the initiative on that will lie with you and your colleagues and with the bank. How do you see that process now moving forward in a way that 6 months from now we will be in a different space on that particular issue?
The most important preoccupation we have at the fund is to concentrate on countries for which the time is now, or actually it was yesterday, and make sure that we work through this case by case in a prudent manner. Diligent was the word I was searching for. And it is maybe me not being able to roll my tongue just symbolically says it is not easy. This is a complex matter, but it is priority for us at the fund, together with the bank. As you know, we work together on assessing debt sustainability, and then we work together with the fund taking a lead on programs that can bring that sustainability in good place. Where we are careful, and I hope people would understand and empathize with countries, is not to throw a blanket of mistrust over all low-income countries.
Exactly.
Because many of them worked very hard to stand up on their feet, be able to access markets, and be trusted by markets for their prudent macroeconomic policies. In fact, when you look at the crisis, we have countries where there have been conscious efforts to increase tax collection, domestic resource mobilization, to improve the environment for private sector. These countries today are doing relatively better. They themselves do not want to be thrown in the same pot with countries that have not done their homework to be in a stronger position. And this is one thing I have actually gotten some of the leaders of African countries calling on me to show that recognition that we are not in a place where we should treat everybody the same. And that is why we are so keen to have case-by-case restructuring processes that bring that sustainability at par. And if I can be very direct here, what we want to see is more efforts by countries to get their house in order, and do the hard work.
Right.
How could it be that we still have a good number of countries below what we are saying is the minimum 15% of GDP collected as revenues by the government, so the government can provide the services necessary to people. Remember Christine Lagarde, for years, when there were good times, would have this simple message: fix your roof when the sun is shining. We are in good place, do what needs to be done. Today, the countries that have listened to this advice or on their own have taken that course of action, they're doing better. And the countries that have not done it, now it is pouring and their roof is leaking. So we have to think of dealing with that in the broader context of dealing with vulnerabilities in economic policy and making sure that we come on the other side with stronger fundamentals,
Right.
so we can withstand the next crisis.
Yes, exactly. No, I think that's true. So I think that's the debt agenda.
And as you were about to say when I interrupted you, which is, I think that then there is the sort of new financing to help them through that. And I know you talked a bit about the sort of really quite exceptional rapid response of the fund. And I don't think I recall any time in history when the fund was so quick out of the block in so many countries. And I want to say also, I know many of your colleagues really worked out very, very hard to sort of get that done in the time they did. So bravo to that. So, but as we know, this is going to be a long, drawn-out process next couple of years. So we come to the next phase, and what are you thinking about that? And there are many ideas that are being floated, new facilities, new ways of helping. What's your thinking on taking that forward?
So you're so right. Emergency financing only goes that far, and we cannot anymore claim this is emergency. We know we are in this long ascent of recovery, and that would call for programs that are oriented to support that recovery. Let me first say that the fund is going to be one of the sources of financing. We want to see more grants for poor countries. This is not what the fund does. As you know, we have small grant giving on debt relief, but that's pretty much where we land. We are going to expand our concessional financing. I'll come to that. But we want to see institutions like the World Bank being able to do more through grant financing for poor countries, and also for development partners to step up. Why? Because there has been an enormous investment in development that has trimmed down poverty over the last decades. And we are now at a point when that may be lost. we're seeing poverty for the first time going up. Together with an increase in poverty, we see a very troubling sign in our projections. Africa, for the first time, with minus growth. The African economy is shrinking. This is bad. What is even worse is that for 2021, we are projecting a meager 3% growth for Africa. For the rest of the world, for the whole world, we project 5.2%. In other words, rather than being the engine of growth, so it can pull up, Africa is going to barely restore some of the lost ground from this year. And with population growth in many countries being around 3%, it means that it would be walking back. This is terrible for Africa, but it is also terrible for the rest of the world because trouble travels. If Africa is in trouble, this is going to have a reflection sooner or later to all of us. So how can we avoid that reversal of fortunes for Africa? That, let's remember, many African countries have been doing quite well. They were dynamic, they were growing rapidly,
Yeah, I mean,
doing
there
the
were
right
many who
thing
were
in
growing
terms
at 6-7%,
6,
and more,
7%,
yeah.
8%
Yes, and
growth.
more, yeah.
So how can we do that? So I see three components of the answer. One is the African governments themselves taking proactive policy steps to further improve investment climate in the countries, improve their fiscal position. In many countries, there is still space to tax the wealthy and the rapidly growing parts of the economy a bit more, to collect more in tax, to cut illicit financial flows. I mean, Africa is still camouflaging money that it needs inside. Two, for the partners of Africa to step up. And that also means for the fund to step up with appropriate, for this crisis, recovery support.
Yeah.
What do I mean? We know that Africa ought to digitalize very quickly. That is the opportunity for Africa to leapfrog. If we are supporting public investments, we are not the World Bank. We don't look at the exact structural impulse, but we do look at the policy framework, and we want to see this policy framework to build the strength of human capital, in other words, investment in education, build the strength of the digital economy, make Africa more competitive. Right now, only half of Africa is connected to the internet. If we get 10% improvement in connectivity, we are going to get 4% boost of growth. It is so clear. We have to zero on that, but also help Africa to deal with the risks of climate shocks that have grown, help Africa to adapt energy solutions that are next generation, not the previous generation solutions. In other words, use the support we provide and the money that Africa is going to raise domestically for a transformation of the economies to be more competitive. And the third part is private sector. Obviously, we have to think about ways in which this very cheap liquidity in the rest of the world can come to Africa at a reasonable cost. Because right now, here, zero, close to zero, under zero, slightly over, here, multiple times higher. Using the credibility of domestic policies and international partners to build a flow is good for Africa, but it is also good for advanced economies, because there is desperation in these aging societies to tap into yield that can be produced only by the dynamic, youthful populations. This is the
The
win-win we
search
have
for
to be
yield
striving.
it can be
It's this
win-win, or it can be
exactly, but let's make this search for you to be calibrated a little bit
right, right.
better, so it can actually work for everybody. I remain on the view that, in fact, there are many that are saying, "Oh, multilateralism is, on decline." I'm on the view that this crisis has told us straight we are interdependent, and in fact, it gives us a chance to build this multilateralism on common interest.
Right.
And our institution has a very important role to play. The simplest way to make the case is by being effective, which means that you would see us very engaged with these countries on good policies and good governance.
Right.
In my dream for Africa, Africa goes digital. I mean, you know how we say the future is digital. Well, the future has arrived with this crisis. Look at us. We are not in your wonderful setting. We are online. And in this future that is digital, if we are to see a impetus for growth, for development, and also for innovation and entrepreneurship, that can be a huge advancement uh, for everyone. But it can only happen if, at the same time, governance improves. There is transparency, no corruption, clean use of public money. And digital can help, because if governments go on digital platforms, they put out how much
Sure.
they raise as money, how they spend the money, then the society as a whole would benefit. And this, you would see us marshaling good governance relentlessly with this new generation of programs we are going to be putting forward, with higher degree of concessionality, or rather doing more on concessional terms than we used to.
Than you were able to do. So I think that
Yeah.
the focus on digital is so right now, because I mean half of Africa has internet, and actually a fraction of the people who have internet are able to use it. They can't afford the services. So there's a lot to be done to advance that. Um, I want to come a bit to the financing. So private sector, getting private money there, is something that, of course, the DFIs have been trying to do for a while. I would say the results so far are not exceptionally great because, for a dollar of even the blended finance agenda has really meant that we've used quite a lot of ODA for fairly limited mobilization. So, but there are things people are trying to do to improve that. And obviously, what you don't want is Ghana borrowing at 10%. I mean, that is not the market access that is sustainable for anyone
Yep.
when the risk-free rates are zero. So somehow we have to close that gap, as you say, and good policies will be a big part of it. Now, coming to the fund, you have a capacity to do concessional lending. You recently expanded it, or are in the process of expanding it, which is fantastic. There's also a discussion about sort of SDR allocation and reallocation and new allocation, going some of that going to low income countries. A lot of people are interested in your thinking on that. So I guess my bigger question is, how do we boost the fund's capacity
Yeah.
to do concessional lending? You've got like a 30 some billion just at the moment. My personal objective is I want to see sort of something in the neighborhood of 100 billion,
Uh-huh.
which is where I think the fund needs to be on
Yep.
that. How do we get there? What's your agenda for that?
So you're so right that the fund ought to expand concessional financing. So far, so good. We came up with a call on the membership to triple our concessional financing capacity, and the membership came through. In fact, it came through with a little more than we asked for originally. But now we are calibrating upward the ask. And the first avenue we are pursuing is where we have full consensus in the membership, or we had built it. I mean, I wouldn't say it was there
Yeah.
immediately, but we built this consensus. And it is on the obvious, commonsensically, we have SDRs. This is the uh, contribution to liquidity the fund is making historically. And we have members that have SDRs but don't need them. And we have members that are in desperate need of financing. So getting those with SDRs that are not critical for their reserves position to own land to us, for us to own land to countries in need, that is the operation that we are undertaking and we will continue to pursue. As we expand the availability of SDRs, to keep the terms as concessional as they have been, in other words, zero interest, well, interest rates are low, but between low and zero, there is still a difference to be covered. And to keep repayment at a longer maturity, the 10-year maturity we have for low-income countries, we need to get from our membership what we call subsidies resources. And that is our next call, turning to the membership. I expect a positive response, but that is our next campaign. Right now, we have enough to continue lending, but I'm thinking of your number, okay? If you want to do more, we need more. On the new allocation of SDRs, the rational concern that has been there for some members is you're going to give an allocation of SDR, 62% of it would go to countries that don't need it. This is not an efficient operation. And for those that need it, you have no helping hand in a way of conditions to get them to stretch to better policies. These are rational arguments. And what I take on board is, okay, so let's see whether we can overcome this. Can we have a solution in which we address this very rational and legitimate concerns? And in that sense, I can tell you, my preoccupation was and continues to be come up with solutions that are rational and that unite the membership.
Right.
We need the membership together. So to be continued, I agree with you that our ambition has to be high because these are the countries that are in most difficult spot. And the fund is created to give a helping hand where it is necessary. I'm not excluding that we would have middle-income countries that today do quite well down the road of recovery to say, well, we actually need more capacity. We see tensions on our balance of payment position. And of course, we, as you know, we have still a lot of lending space. So we have 280 billion exposure. We have up to 1 trillion capacity to lend.
Right. So maybe worth just spending a minute or two on then the middle income countries. Because we've been talking a lot about low income countries and they obviously have special issues. But so you have a lot of middle income countries that are hoping to get back to financial markets at some time because that's really their main source of external finance, but it might take a little bit of time and rates are high at the moment. They have also been quite hard hit, so they've come to the fund. You've already helped some. They're probably going to come back again. Some of them have issues around lack of clarity on how sustainable their debt is going to be, and so that makes it harder to provide funding. Are there ways in which you think one could help countries that are middle income with a sort of second round of help, even while their long-term prospects are still not so clear, while the dust settles, if you like, because we really don't know where the dust is going to settle for some of them.
Yes. Look, let me. I have been using this image in my head on where we are today. Our economy is like a ship in rough waters, and it is trying to get to shore, but it is not there yet. In other words, we can't use an anchor
Right.
just yet in terms of what exactly our projections are, what our fiscal rules should be. Where we are in this high uncertainty, we see the future for emerging markets in the following manner. If our baseline scenario materializes, that is, we are going to have vaccine and or treatments, effective treatments, by mid next year, 21, and by the end of 22, there would be a complete eradication of the threat this virus presents to people and to the economy. Then, if that materializes, we would have three groups of emerging market in different places. One, countries with strong fundamentals, diversified economies, large share of manufacturing, less dependence on contact services. They're doing with strong fundamentals, they're doing well, they're accessing markets with no problem, they're borrowing at very low cost. These countries might need some additional injection from external sources like the fund, or maybe not. And actually, this universe, they're closer to where advanced economies are.
Right.
The second category are emerging markets with weak fundamentals or high debt vulnerability. There, my call on countries is face your problems, especially if that is your burden, face it sooner rather than later. And there has to be recognition that we saw Ecuador, we saw Argentina. In this universe, there is a particularly important space for small, highly dependent on single sector economies, either highly dependent on tourism, like the Caribbean, or commodities. For these countries, for this category of countries, we have to be clear that it may be necessary to work out support programs that are recognizing this vulnerability. And to be frank here, I think these are countries where the whole question of how they shape up an economy that is less exposed to these kinds of shocks, not a trivial question, but one that we need to work
also a
with.
longer term thing in a way, right? I mean,
And then there is a small group of countries that are really highly vulnerable to a point that, in my mind, they're very similar in their needs to low-income countries,
right,
where there has to be more attention to how they can be helped. They're either tiny economies or they are hugely dependent on one thing, and on top of it, they have debt vulnerability. And at the fund, we are actually discussing for the small island economies whether we can come up with something that is a quasi concessional mechanism. As I'm sure you're aware, these countries have been calling for vulnerability index to allow them to be recategorized. Some of them were recategorized in either context,
right,
not vis-a-vis the fund. And I personally have great sympathy for this special
right.
case of high vulnerability. Now,
And
in all of those, never mind where you are on the spectrum, and it is really a spectrum from doing very well, being more vulnerable, being highly vulnerable. Whenever you are, if the recovery does not materialize on our baseline scenario, there can be different developments. Optimistic, we get vaccine in January, the world mobilizes it, and it is deployed universally in months, one, or we actually take longer. I think we need to, as an institution that supports countries in trouble, pray for the best, prepare for the worst, be there for countries to help.
And I guess absolutely. I mean, in a way, that's the nature of the fund's business. Is to help
Mm,
countries prepare for the worst. And you could argue that so there, what is sort of how vulnerable they are, as you
mm,
say, on this spectrum,
yeah,
and kind of either end of the spectrum, what you need to do is relatively clear, right?
mm,
The more you come into the middle,
yes,
the more complex the
yeah,
right package becomes. And I guess the other question
mm,
is the uncertainty around outcomes, particularly relating to how much of a problem their debt will be. Will it be so you don't want to act prematurely, but you still don't want to wait until everything is sorted out. Um, do you think the fund will need to find ways of working
mm,
in a I want to use the term of fog, but in uncertainty more as the norm for the next 2 or 3 years. I mean, one of the things that I think is great about the fund, we'd like to do point projections,
mm,
so there is a degree of certainty
yeah,
underlying the projections of fund programs. But obviously, the fund changes its programs and projections in light of evolution, but at any given time, there's a sort of fairly deterministic picture of the world. And I kind of wonder whether that's the model, how effectively that model
yeah.
will work for the next 3 or 4 years when we are sort of collectively and individually walking through a bit of a fog.
Yeah, I have given a lot of thought to this question, as you can imagine, Masood, and I came up with two conclusions. The first one is that, like never before, we need coordinated action, and I take the significance of finance and central bank authorities to coordinate on the outlook, and obviously for the fund to, in a very agile manner, give as much light in uncertainty as we can. This takes an incredibly high significance. Uh, while there has been a lot of criticism that perhaps there hasn't been the same level of pronouncements by heads of states as there was after the global financial crisis. In fact, the mechanism of cooperation of finance and central bank authorities has proven to be durable, and it is paying back. And I would stress that as we think about next stage, what is the question we will have to ask? What fiscal stimulus,
Right.
how to deploy it, and for how long? And there the fund has an incredibly important role to bring that consensus, of course, also the G20, the G7, the formations that we have. But the fund traditionally would be the one to, as you know, to give an outline and calibrate what that should look like. Are we talking about 3 years of fiscal stimulus or 2 years of fiscal stimulus? At what level? What is the fiscal framework to then, as the ship gets to shore to anchor sustainability for the future. And I can tell you that our team is totally geared to calibrate the answer to this question, recognizing that uh, the more we know, the better the answer becomes. But it is a highly uncertain environment.
That's the world in
Uh,
which we're living. Yeah. Yeah.
Totally. The second conclusion I drew is about the increased responsibility for the fund on fiscal policy for the 21st century. Obviously, there are others that need to step in. We have the OECD working on digital tax. We have the various groupings of countries looking into this issue. But when I came to the fund, the first thing I was told was IMF stands for it's mostly fiscal. So how do we, and we have to admit, fiscal policy, taxation, public spending, incentives, disincentives, it's doing a job, but it is a little bit kind of 20th century set of policies. They haven't quite stepped forward. So you see the fund. Where are we? We look at inequality and how taxation can address inequality. We look at quality of public spending, how we can inject more investment in human capital. And we think of resilience as a much broader concept than banking sector resilience. After the global financial crisis, we did it. The banking sector today is withstanding a massive shock.
Right.
But we need to think of resilient people, resilient communities,
Climate
resilient
obviously comes right
planet,
into it. Yeah.
resilient planet, not just resilient finances. And the fiscal posture, the forward-leaning fiscal posture on that is going to play a huge role. So I see for us this huge responsibility. 2021 is going to be a very important year for the world. And I can tell you, I feel that responsibility for us to play our role, obviously among many others, but for us to play our role in this year on these two big teams.
And I mean, I think you're so right in terms of the role of the fund as being a sort of global convener, but also of pulling together and laying out a sort of path for tackling common problems. So, where there's a fiscal set of issues, I kind of think that on dealing with debt, similarly, a framework has to be laid out that the fund is best placed to sort of say
Yep.
this is the way forward. Maybe on the financial sector, I think the banks have done
Mm,
fantastically so far. I do worry that when we see the all the stimulus
mm,
packages being pulled back, we're going to
mm,
discover that a lot of enterprises that are being kept alive will not
mm.
be
Yep.
sustainable, and that will spill over into a banking sector
Yep.
crisis. Or crisis may be too strong a term, but there will be banking sector problems in many, many countries. So down the road, the third shoe to drop after the
Yep.
health crisis, the economic crisis, is a sort of banking crisis down the road, maybe, which at some
Mm,
point we'll have to deal with. And I think the
right.
fund is really the place that helps to bring the global community together
Mm.
to lay out these things in that agenda.
Yeah,
Now
we
we have
are we are in an inflection point
exactly.
right now, not very different than what was the situation of the world when these institutions were created. And in this inflection point, we need to do two things: restore the functioning of the economy after a massive shock, but also shape up a more resilient future. And all of this is based on good policies
uh,
that are applied globally in a harmonized manner.
And the harmonized manner is an important point because you were talking about your ships coming into, so I think of like multiple ships coming into shore,
Mm,
and And there's probably some merit also in them having a degree of coordination, because there is
Mm-hmm.
the slipstream effect that if they all
Mm-hmm.
do it together, maybe
Yep,
they achieve more than if they do it in an uncoordinated way. So that's also
definitely.
one of the things the fund can stress, I presume, in its work.
Yep. Definitely, definitely. And you look at the ways the fund has changed in its history quite remarkably. It was created when there was a gold standard. There was an evolution on exchange rates following a very massive shift in the monetary system. And then we had an explosion of membership with my country at that time coming in, uh, a very massive transition of a big part of the world from century plan to market economies, with the fund playing a hugely important role in this transition. Now we have the pandemic, a health crisis that has created a massive economic crisis at a time when, if you look at 2019, there were problems building up: low productivity, low growth, high inequality, a looming climate crisis. As we deal with the recession, it is our chance to address these problems from the past. And that would take, as you rightly stress, a concerted effort.
Right.
Cannot be done one country at a time. So we will have in 21, they are, the UK is going to lead the G7. It is a very important format. Plus, they have the responsibility for COP26. Italy is going to be at with the presidency of G20. Uh, we have um, fortunately, two countries that come from, although they have now sort of decided that they're not going to be exactly in the same family, they're still from the same neighborhood.
Right.
Uh, in other words, with some unity of purpose coming from there. And we have a world that is sobering because of what has been happening, with over 1 million people gone, massive destruction of
Of
livelihoods,
course.
which kind of brought back that sense of asking ourselves what really matters in life. And I think we have to use this sober recognition that we are interdependent, and what matters in life is to have that ability, when a shock hits, to come out of it, and to come out of it stronger. I'm uh, an optimist. I actually believe that in a deepest of crisis is when the best of opportunities are born.
Well, I think that's a nice note, Kristalina, on which to bring this conversation to a close. I think you're always focused on trying to find solutions, and today is no exception. And I would say, the next 12 months probably is going to be the moment when we go from diagnosing the problem and dealing
Mm-hmm.
with the hemorrhage to, actually crafting the solutions to these problems and framing the way in which we can take the global economy forward in a more inclusive, sustainable way for the next 5 years. So you and your colleagues have a pretty full agenda for the next year. Um, I hope we'll have a chance, uh, maybe in a few months, to have you back and see how well are we transitioning from the current phase of crisis management to the solution implementation phase next. And it's always a great pleasure to have you back with us. So thank you for your time and for your engagement.
Thank you. Thank you for a great conversation as always. And yes, As long as I get an invitation from you, um, it would be on my agenda. I would be
Great. You have our
thrilled
standing
to come.
invitation. You know that.
Thank you.
Excellent.